Welcome to the ultimate financial showdown, high-interest debt versus housing. In this episode, we will help young professionals navigate the dilemma of paying down costly student loans, often around 8%, versus saving for a home down payment. We will move step by step, from the core principles to a practical plan, and we will walk through numbers, diagrams, and a mini case study. By the end, you will have a clear, security-first strategy to prioritize your next financial move with confidence. Before we begin, a quick but essential disclaimer. This video is for educational purposes only and does not constitute financial, tax, or legal advice. Everyone's situation is unique, so you should consult a qualified professional who can assess your specific circumstances. Also, the examples and numbers we use are simplified for clarity and may not reflect your lender's exact terms or your tax bracket. With that in mind, let's proceed. Here is our roadmap. First, we will frame the dilemma and the mindset behind a security-first approach. Next, we will demonstrate the math of 8% debt being equivalent to a risk-free 8% return. Then, we will lay out a practical, step-by-step plan that protects your cash flow and builds resilience. After that, we will run simple numbers, address common objections and market timing arguments, and finish with specific action steps. Finally, we will reinforce learning with a couple of short quizzes. Let's set the stage. Many young professionals face a big choice. Do you aggressively pay off high-interest loans, or do you allocate that same cash flow to a home down payment? The guiding principle is simple. When your debt carries an interest rate around 8%, paying it off is effectively the same as earning a risk-free 8% return. That's very hard to beat in the markets without taking substantial risk. A security-first mindset means you shore up cash flow and financial resilience before you layer in a mortgage, which is a large, long-term obligation. This approach reduces vulnerability and leaves you better positioned to seize opportunities later. Now, why prioritize 8% debt? First, eliminating that debt is equivalent to achieving a guaranteed 8% return. Markets can be volatile, but paying off interest is certain. Second, the moment those high-interest payments disappear, your monthly cash flow improves, which increases your flexibility for saving, investing, and handling surprises. Third, sequence matters. You will achieve better long-term stability by securing your base first and only then taking on a large asset purchase like a home. Finally, be cautious not to deprioritize tax-advantaged accounts. Maintaining contributions to accounts like an HSA or IRA can lock in tax benefits that compound for decades. This timeline shows the security-first sequence. Phase 1. You build a starter emergency fund to avoid using high-interest credit for small shocks. Phase 2. You continue contributing to tax-advantaged accounts while aggressively paying down the 8% loans. Phase 3 begins the moment the debt is cleared. At that point, you redirect the entire cash flow that had been servicing debt straight into the down payment fund. Phase 4 is the actual home purchase, done when your cash flow is strong and you have sufficient reserves to handle maintenance, insurance, and other homeowner expenses without stress. Here is your actionable playbook. First, create a starter emergency fund covering 1 to 3 months of essential expenses. Second, keep contributing to tax-advantaged accounts like an HSA or IRA because the long-term tax benefits can be significant. Third, where possible and applicable, use grace periods or cancellation windows, such as certain 120-day provisions with some lenders, to minimize or refund interest accrual when payments are adjusted or loans are dispersed. Policies vary, so verify with your lender. Fourth, send all remaining cash flow to the high-interest loans and accelerate payoff. Fifth, once the loans are gone, immediately redirect that entire payment stream to your down payment savings. Finally, build adequate reserves for closing costs and ongoing homeownership expenses so your cash flow remains resilient after you buy. This pie chart illustrates a sample allocation. It is not a prescription, but it shows the logic of preserving tax-advantaged contributions, maintaining a modest emergency buffer, and dedicating the majority of free cash flow to high-interest debt. After the payoff, you would reallocate the debt slice directly to your down payment fund. Your exact percentages will depend on your income, expenses, and risk tolerance. Let's examine a simplified 24-month snapshot. Assume you have $2,000 per month of free cash flow after essentials and tax-advantaged contributions. In the debt-first path, you send roughly $2,000 per month to an 8% loan and finish around month 16, acknowledging some variance due to interest. Then, from month 17 through 24, you put $2,000 per month into the down payment fund, reaching about $16,000 by month 24, with zero student loan balance. In the split path, you put $800 per month to the loan and $1,200 to savings for the entire 24 months, ending with around $28,800 in savings, but still carrying approximately $15,600 in student loans due to interest drag. These figures are approximate and for illustration only. Your exact results will vary with principal, interest compounding, and any minimum payment requirements. Here is the head-to-head comparison. On the debt-first side, you replicate a risk-free 8% return by eliminating expensive debts. You also accelerate your path to cash flow freedom, reduce vulnerability to financial shocks, and often simplify both qualifying for a mortgage and managing it day to day. On the buy now side, you may capture market appreciation sooner and gain homeowner experience. However, you will face greater cash flow strain and the continued interest drag from old loans, which can erode your flexibility for years. Now let's address the controversial view. Some argue housing returns will beat debt costs and that you should get in as soon as possible to catch appreciation. The rebuttal is that liquidity and cash flow are paramount. Paying off an 8% loan is a guaranteed return and materially reduces risk immediately. Sellers worry about missing the market. Entering debt-free with a strong emergency fund and zero high-interest payments leaves you in a position of strength. You can act quickly and sustainably when the right property appears. The bottom line is to prioritize long-term financial freedom over rapid asset acquisition. Quiz time. Paying off an unsecured loan at 8% APR is most comparable to which outcome? Option A, earning a risky 8% stock market return. Option B, earning a risk-free 8% return. Option C, earning a 4% return after taxes. Option D, no meaningful financial benefit. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Eliminating an 8% guaranteed expense is financially equivalent to earning a risk-free 8% return. That certainty is extremely powerful compared with the uncertain nature of market returns. Second quiz question. Which contribution should generally be preserved while you attack high-interest debt? Option A, HSA or IRA contributions that provide long-term tax benefits. Option B, discretionary luxury spending. Option C, new car financing. Option D, contributions to a day trading account. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A. Maintaining contributions to tax-advantaged accounts like an HSA or IRA typically preserves long-term tax benefits and compounding. While each case is unique, these accounts often deserve priority even as you accelerate high-interest debt payoff. To keep momentum, automate payments and transfers so your plan runs with minimal friction. Ask your lenders whether grace periods, payment refunds, or 120-day cancellation windows apply to your loans and how they affect interest accrual. Avoid taking on new high-interest debt while you are working to eliminate the existing obligations. The moment the debt is gone, redirect that payment stream directly to the down payment fund. And keep an emergency fund appropriate to your personal risk level and your local housing cost environment. Here are some quick Markdown mini-notes to anchor the logic. First, the return equivalence. Paying 8% interest is the same as earning a risk-free 8%. Second, the recommended sequence is emergency fund, then maintain tax-advantaged contributions, then eliminate the 8% debt, then save for the down payment, and finally buy. Third, the cash flow mantra is to eliminate fixed drains before adding new obligations. Fourth, use a risk check. If a single, unexpected expense would break your plan, rebuild your base first. This sequence diagram traces the flow of money through the plan. The person allocates income into the budget. The budget channels aggressive payments to the debt. Once the debt is cleared, those dollars return to the budget as freed cash flow. The budget then redirects that amount to the down payment fund. When the fund reaches the target, the home purchase occurs. Finally, the home purchase, done with strong reserves, returns stability and predictability to the person's cash flow. In summary, paying off an 8% loan is a powerful, risk-free return. A security-first sequence protects your cash flow and meaningfully reduces risk. Maintain contributions to tax-advantaged accounts, even while attacking high-interest debt. Once you are debt-free, redirect the entire payment amount to your down payment fund to accelerate savings. Then, enter the housing market from a position of strength, with resilience that supports long-term success. Thanks for watching. If you found this helpful, please like the video, share it with someone who is weighing debt payoff versus buying a home, and subscribe for more practical money strategies. In the comments, tell us your current priority and why. Are you paying off high-interest debt first, or saving for a down payment? We would love to hear your reasoning and questions.